This is the Bad Trader segment on how the are bonds priced.
How the absolute can we
Our
make money
bonds.
on this? Or how can we
Exactly.
lose money on this?
Yeah,
How
you're like the
can
bottom
we-
right, like the OG.
How
I don't know if
can
you
we
played
take risk?
the N64 bond.
You
ever play that?
play GoldenEye 007, Vaughn?
Yes, dude, bro. Every time that screen would pop up, I'd just be like, all right. Anyway, without further ado, the Bad Trader segment on how the are bonds priced. All right. How do we track these things, James? Oh, no, I clicked too quickly. What's a bond? I'm going to call it a boomer buck. It's a boomer buck. What is a boomer buck anyway? So bonds are debt securities issued by governments / corporations to raise money. The face value is how much the boomer buck will be worth at maturity. And then also important to note is the coupon rate. This is a fixed interest rate that a bond pays annually. For example, the coupon rate is 5%. It means that the bond pays 5% of its face value in interest every year. So we can think of a $100,000 face value bond with a 5% coupon that pays you $5,000 annually or semi-annually if you're talking about U.S. debt.
Yeah, so if you got a $100K bond paying out 5%, you're getting a $2,500 interest payment every 6 months.
Our pricing factors. Well, how do these things move? Interest rates, obviously, credit ratings, economic conditions, and the good old Adam Smith. Supply and demand, baby. We'll be jumping into that a little later in the presentation, talking about our thesis, why we took some of these trades. But, James, take us through, man. How do we track these things? This is what we had trouble with.
This is what we had trouble with because Ivan does not know how to price bonds.
I don't know how to price a motherfucking bond. You got some fractions in there,
There's some fractions in there. There's some
Thomas isn't the best with math.
It looks like you're reading Egyptian hieroglyphs. I feel like back when King Tut was the leader, he was like, all right, we're going to make the first bond. And it was probably written on a slab of clay. It's probably buried with him inside of the pyramids. So, man, I feel like people had a bad time getting their interest payments. I feel like back then when you had to get your interest payments, you had to like ride a cow into the center of town and make sure
and then
that
these things have just been esoteric ever since. It's just been.
I think that in the Roman times, however, I know that salaries were paid out in salt. That's where the word salary comes from. So I wonder if they had salt bonds back then.
Is that actually where salary comes from?
Yes, it does. Yes, because salt was so rare back then. They got paid in a salary.
Salary. I like that. That's pretty cool.
Anyway,
you got
bonds are quoted in
terms that make you interesting.
My bad. I cut you off there. Bonds are quoted in terms of ticks and points in the futures market, which is what we are talking about today. We are not buying bonds. We're not outright buying.
We're not boomers, man. We're not doing that boomer buck shit.
I'm not sitting around collecting $2,500 every 6 months until I can't breathe. I am making or losing, most likely losing money by trying to make money. So the creator of bonds, the creator of this pricing model, Vaughn, you can read this.
Let's say King Tut. Let's say King Tut.
The creator of this pricing model. So King Tut was 100% a neckbeard Discord moderator, Reddit admin. Never felt the warmth of a woman.
I fucking love that. James.
Yeah,
that was exactly what King Tut and whoever the fuck created bonds.
I feel like back then they just didn't know how to render in like actual legitimate pricing models, and so they had to go with these apostrophes. They had to go with some weird esoteric way to quote. Oh, the price is typically quoted as a percentage of the face value of the underlying treasury bond in points. The first number is followed by an apostrophe and ticks. The second number followed by a quotation mark. So what that means is there's two numbers that you read. And for example, if a bond is trading at 99,16 apostrophe, wait, which one's an apostrophe? Which one's a comma? I don't even know. This is what I mean by use the touch grass, Discord mod. But either way, if a bond is quoted at 99.16, it means that the bond is trading at 99 and 16 30 seconds, or 1/2 if you didn't take math in school for simplicity, of the face value. To calculate the actual price, you need to convert this to a decimal and find the bond trading at 99.5% of its face value. Vaughn, can you dumb this down a little bit, because I feel like I can't speak English some days.
Let me dumb this down. All right.
A bit.
Thomas Athey is 100% a neckbeard Discord moderator, Reddit admin who has never felt the warmth of a woman. That's all you need to know. That's the takeaway here.
That's the takeaway here.
That's the takeaway. Thomas probably had something to do with the fucking pricing model because it's confusing as shit. And like, bro, just like reduce the fractions, man. I don't know.
I feel like if we go back in time to the Egyptian era, we see a hieroglyph carved in on one of the pyramids. It's just Thomas Athey with
Thomas
just
with
a
the
badass
Polish
beard,
flag.
sitting in
Polish
front of a
flag,
computer.
pierogi.
And back then, the computers ran on like hamsters running like a little fucking like energy farm, and he's just like, bro, they just came out with like what's like a good commodity that they just came out with at the time. He's like, bro, I'm trading these bronze futures, man. Like
no, like blankets. And he's like, bro, I can't feel the warmth of a woman, so I need a blanket.
Dude, the blankets just came out. You gotta try it. Oh, no. It's like, yo, hey, did you hear about the new tech sector? They just dropped the wheel.
We're at the derivative market. All right, James, let's move on here. The only slang way to speak bond language is if you see the 9916 quote. You read it as 99 tick 16 apostrophe
99 tick 16. So it's 99 points tick 16. So 16 ticks. So 99 tick 16.
99 and a half. Fuck it. All right. Each point is composed of one 1/32 of a point for 30-year bond futures contract with a minimum tick value of $31.25. Further divided up into 1/64 ticks if you are trading options on bond futures. Every point is equal to $1,000. That is what we were confused about. But James, before we learned anything about how to properly price these things, I mean, I guess we kind of gauged it. We went balls to the fucking wall, which we will see next slide. But finish it off, James, with the final points.
So the dollar value of a single contract can also be calculated from the quoted price. This is important because it tells you the total value of the contract. To calculate the dollar value, multiply the quoted price by the face value of the bond. For example, if the face value of the 30-year Treasury bond is $100K and the quoted price is 99 tick 16, then the dollar value would be $99,500 or 99.5% of $100K.
Right. So
simple enough to understand.
Par. Yeah.
Trading below par. Right now, we're trading above par, which we can dive into in a second.
Yeah. But takeaway here: each point is composed of 1/32 of a point. So these are the ticks. Every tick is $31.25. This is what we really fucked up on. This is why I completely missized my position.
So what that means is, disregarding everything else that we said because we probably don't sound smart enough, because we probably don't explain this well enough, and because Thomas Athey is a neckbeard Discord moderator.
Exactly.
If you buy a bond at 99.5, or as we said here, 99 tick 16, if you bought a bond for that price in the futures market, you're buying a 30-year going long, your tick value is 31.25. So what that means is if the value of your bond goes up from 99.5 to 99 tick 17, so it went up one tick, you would be up $31.25 on that
is
trade.
Literally all you got to take away, because
all
that's
you got to take away from that.
About.
All you got to take away, if it went down one tick, you're down 31.25. Disregard everything else. We don't care because we trade price and we try to make money on it. And
we're not a boomer buck holder. All right, James. So why do we care? Because we dove balls to the wall. We said, fuck it. We're not going to figure out how these things are priced. Maybe we had some idea, but damn, man. Like, in hindsight, this position was way too large, and I'm just really, really glad it went in my favor. I mean,
you love going large, man.
I love going large, man. Living large like Larry. So, James, what did we do?
I like to compare this to when we went to the casino, when we went to play Baccarat. You were like, how the fuck do you make money at Baccarat? How do you win?
Yeah.
And I'm literally saying it's a coin flip. It's either one or the other. And so I sat down at the table. You're like, so how do we play this? And the dealer was like, have you ever played roulette? Red or black? Same exact thing. Bonds. You're either long or you're short. You're either going up or you're going down. That's how we play it.
Yep.
Vaughn's thesis was simple.
It was simple, which we'll get into in the next slide. But this little recap. What happened? Why do you care? Well, James, we took out a little 14K winner here. This was a good 8 days of work. 8 days worth of work. I'm happy with how it worked out. We pieced in and out of this position. So we opened our first short on September 19th at 2:20. That was the day we were talking about. I believe it was a Friday, man. I remember it like it was just last week. Oh wait, it was. We were chatting about this thing. We said, all right, here's our thesis. Here's why. Boom, short 2 contracts, short another one, and then I realized that I was trading on intraday futures margins. So I had to close a couple of the contracts out, but I reopened them the following day. I really wish they didn't get closed out because they would have been making some nice money 2 days later. But yeah, so closed them out, reopened it the next day, kind of pieced in and out, covered at 16 tick 12, 116 tick 12. And then, yeah, just kind of pieced in and out. Finally closed my position down here at 115 tick 11, 114 tick 17. And then this one was the banger, 113 tick 22.
So you closed them, you were piecing them out. You had 4 contracts total, piecing them out at 115, 114, and 113 pretty much?
Yes.
We like it. That's a very tasty trade. You stuck it to the neck beers, all right.
I stuck it, and, I'm very happy with how I managed the risk, despite the position being too large. We had a game plan. We had a thesis. And it ended up working out. We've been getting lucky with these things. So nice little
10-day trade, making you 14 grand, making a nice 1,400 a day on average.
So I'm happy with that. Can't complain. Let's talk a little bit about the thesis. So we had 2 kind of major components playing when we were discussing this trade. The first one is going to be kind of the fundamental side of things, the increased treasury issuance. So here it is from the Treasury's website. Over the next 3 months, Treasury anticipates incrementally increasing auction sizes across benchmark 10 years. Treasury plans to increase auctions, whatever, all this boomer language. All we need to take away from this is the Treasury plans to increase both the new issue and the reopening auction size of 10-year notes by $3 billion, 30-year bonds by $2 billion, 20-year bonds by $1 billion. So long-term, Treasury issuance is going to continue increasing. What does this do for supply and demand? The good old Adam Smith that we were talking about. Well, yields need to go higher in order to try to make up for that increase in supply, right? Like more treasuries are coming onto the market. If there's not more people gobbling these things up, you got to increase the yields, right? So people are going to be selling them, whatever, blah, blah, blah. It gets kind of complicated. But, oh, man, you're trading, man. You're trading. You're such a freaking little iPad kid.
I'll show you that. You're going to like it. You're going to like it.
I'm going to like it, yeah. I'm getting a little battered in gold, but we'll talk about that in a sec. But anyways, main takeaway.
Gold trade? Oh, yeah. No,
yeah, I've had it on.
You're going to like it. You're going to like it. Trust me. You're going to like it. It looks like the Batman symbol.
I love it. Anyways, main takeaway here is long-term supply is going to be increasing in the treasuries. If demand isn't, if demand isn't there, yields are going to have to go a little higher, blah, 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 higher for longer trade, yada, yada, yada. And then coupling that with the U.S. debt increasing, how are they going to fund this deficit? Well, by increasing auctions moving forward. So that was there. Kind of had the supply-demand dynamics working for us, plus some stuff happening abroad and foreign debt markets. But we won't get into that because that's just a little technical, a little nuanced. All you need to know, supply increasing long-term, demand, whatever, pretty much staying stagnant. Yields need to go higher for longer. Great, awesome. And this is happening the back end of the curve too. So, and then the technical side of things. I mean, historically, this 116 range that we were actually was like 117, 118 range has been a very, very key range, literally for the last 2 decades. So really cool to trade around this historically important support resistance. As you can see, early 2000s, this was an important resistance. Bonds would not trade higher than this 118 range. We had some chop here for a couple of years. It's kind of cool how these things play out. And then within literally a week, we broke through this very, very important range. So we were playing with our stop losses at 120, but we had a pretty clean breakthrough at 118. So very happy with how this thing played out. I think for the most part, most of the money to be made was already made. So, I decided to take some of the tokens off, if you will.
Yeah, take some of the tokens off. I got in here with the delta neutral, capitalizing on this nice increase in volatility. The sell-off.
Yeah, we'll have to take a look at it, man. Let's jump into the brokerage
directly in the middle of where I set it, so it's pretty nice.
Yes.
All right, let's get this.
Wait. What about oil? Like 2 days ago, man. I woke up to $95 oil.